Studio in New York City. It's a Friday, folks. I'm Julie Hyman, that's Josh Lipton, and this is Yahoo Finance Live. Here's who we're watching this afternoon. We're an hour away from the closing bell on Wall Street, and investors are looking at another record day for the Dow and the S&P 500, but stocks are losing some steam heading into the close. Earlier in this session, the S&P 500 crossed 5,100 for the first time.
And Wall Street is capping off a winning week, thanks in large part to Nvidia. Stock setting gains after its blockbuster earnings report this week, driving the company to a $2 trillion valuation. We're going to be looking at where there might be other opportunities for your portfolio.
Plus, the 2024 campaign heating back up with the South Carolina Republican primary tomorrow. The results could be the next step in cementing a 2020 rematch between former President Donald Trump and President Joe Biden. We've got expert analysis on what the election results could mean for your money. Let's get you up to speed on the market action here. If you look at the three major averages, as we said, things are losing some steam here. Any gain, again, for the Dow, the S&P, and the Nasdaq 100, for that matter, would mean another record close. But it looks like the Nasdaq Composite's not going to make it to a record today. It has been the one that hasn't set a new all-time high, down about almost 0.2% right now after earlier rising on the day. The S&P 500, after crossing over that 5,100 mark, is now up just 0.1%. The Dow up about 1/5%, or about 71 points. Utilities, which had been really the sole laggard yesterday, are up on the day today, rebounding by about 1%. Consumer staples and materials also higher. Consumer discretionary is the laggard today.
Yeah, I mean, it's interesting, Joe, as you know, we don't see a kind of ton of traction in the major averages today, but the context here, of course, is what we saw yesterday, which was historic with Nvidia, biggest one-day gain in market cap in history, dragged the markets right up along with it. And by the way, if you bet against Nvidia, that was not so great. Bloomberg noting the surge in Nvidia shares left short sellers with about $3 billion in paper losses. So today, perhaps a bit of a breather here. Some of the Magnificent Seven, by the way, I've seen some of those names also under kind of a bit of pressure.
But Nvidia isn't one of those, by the way. The stock is
Keeps
still
trucking higher.
going
I know.
higher today, which is incredible. And something that we've been tracking and talking a lot about is the number of analysts who say it still has room to go higher, which is pretty astonishing.
Well, how many analysts did we have on the show who were saying the valuation was very attractive?
Yeah, that they would still get in here. Although some of them would say there might be other places you want to look right now, Nvidia, because of its huge run. Something else we should say is that Nvidia really has had an enormous effect on the market. We expected it would, and indeed it has. If you look at the S&P 500, for example, on the week, it's set for a gain of more than 1.5%, even with the sort of fading rally on the day. That means if you go all the way back to the beginning of November, there have been only 2 down weeks for the S&P 500 in that period of time. We had talked about the big streak it was on. I mean, more or less, it's still on a streak that, with just 2 down weeks in that period. It's still a pretty incredible run. Yeah,
it's impressive. I mean, listen, you look at Nvidia, which has become the proxy for AI, and so when they reported and beat and surged, you drag a lot of other names along with them. You saw those immediate pops in AMD and Intel, and also maybe it just for investors, perhaps maybe they're more confident in one storyline of AI, which we've talked about, which is that, listen, there's a lot of bulls who bet that you're going to see this kind of ramping use case and monetization.
Yeah, I'm sure that Jared is going to update us on records later in the day, but some early ones he sent us, a record for the SOX ETF, the semiconductor ETF, not surprising, a record for Meta. Now, these might not all close at these levels, but they at least touched intraday records in the course of the session. Meta, obviously, Nvidia also touching a record on the day, but a lot of other stocks as well. JP Morgan touching a record today, Workday touching a record. So it's sort of stuff that Broadcom touching a record ahead of its earnings next week, American Express. So it's kind of spread out here.
Yeah, the chips that you mentioned are really interesting, though, because they are cyclical and because they do tend to lead markets up on the way up and the way down.
Yeah. Well, now with Nvidia results behind us, investors' focus begins to shift back to the Fed's next move. For more on what we can expect, let's welcome in Tim Chubb, Gerard Chief Investment Officer. Hey, Tim, it's great to see you. It's been a little while.
Yeah, thanks for having me.
You know what? Before we talk about the Fed, let's talk a little bit more about Nvidia. Why don't we? Because I know that you're thinking about it as well, thinking about not just its role in the market, but the sort of Magnificent Seven's role in the market. Even though there's been some talk about making it a Magnificent 4 or 2 or 1 or whatever you want to say, we still have seen large cap tech outperforming. What do you make of that? And do you think it is too late to chase it?
Well, it's where the growth is. And if, although this earnings season certainly had better growth than we expected, I think early in the season we were looking for about 3% earnings growth and came in around 7 on better margins. I think generally speaking, a lot of that's being driven by the Magnificent Seven. And like you mentioned, even more concentrated than that. And I think year over year, the group is up, about 700 basis points versus about a 200 basis point decline for the other 493 companies. So, getting to Nvidia, we certainly are in the early stages of the AI revolution. It's really exciting, and there's certainly no valid substitutes anyway for what they do. But as you mentioned, there is quite a bit of concentration amongst their customer base of other Magnificent Seven companies. I think Microsoft for 2 or 3 quarters now has been about 20% of sales, and I think overall as we head into the rest of this year, it's such a difficult company to value, and obviously the artificial intelligence momentum seemingly unabated after the report this week. But it definitely is maybe a good time to take some off the table. And like you mentioned, there's some other opportunities out there in the market, although it's hard to fight back too hard against some of the growth numbers that they've been able to report recently.
And Tim, though, it's interesting. If you were going to book profit, are there other sectors that you think just look more attractive to you here?
Yeah, technology as a whole is fairly attractive. We own quite a bit, of the Magnificent Seven, minus 1 or 2 companies. And overall, we continue to expect some pretty outstanding results from some of them, including Meta as the year goes on. But overall, healthcare remains one of our favorite sectors. It's our largest overweight. We've been arguing that it really has the characteristics of reaccelerating growth, and we finally have seen inventories bottom in bioprocessing. We've started to see some green shoots within the venture capital lending, which will ultimately, will help drive further innovation in drug and therapy progress within the R&D cycle. And so, within that, we like a lot of tools and diagnostics companies. One of our favorites is Viva Systems. It's a software name, really catering towards healthcare companies in a variety of different ways. And ultimately, it's bigger wallet share. And as a lot of these companies begin spending a bit more and getting through the R&D cycle, they've got a really great product with their RIM solution that ultimately will be well positioned to take advantage of the increased CapEx spend there.
Yeah, it's interesting to look at not just at the healthcare providers and pharmaceutical companies, but something that is providing them with services. I want to circle back around to the Fed because obviously we have seen some changing expectations for when the Fed is going to be cutting rates, and the market has seemed somewhat unfazed here. Is it a risk, though? Is there a risk that sort of changes? Can the Fed sort of still upset the apple cart?
It's possible. I think right now, everything we've heard really since that December meeting when Powell had come out and said that, will likely, ultimately that huge pivot, it's been balanced. The risks are balanced. There's, more balance in the risk between their dual mandate of full employment and price stability. But, the January inflation print, at least from our perspective, was, a bit of a pothole, a speed bump, not a pothole. And really an outlier report that I think, ultimately as we go on throughout the quarter and we have 2 more reports, ahead of the May Fed meeting, that we will get the disinflation progress that the Fed is looking for to have that confidence to cut interest rates. And one of the things I think the market may be underappreciating a bit is just how much the Fed is passively restricting things right now. Taking into consideration Fed funds at 5.25 to 5.50 with inflation that I think is a lot closer to 2% than many would realize after making some adjustments to the shelter costs. Ultimately, it means real Fed funds rates over inflation are about 325 to 350 basis points. And so, couple that with the continuation of the unwind of the balance sheet and the other challenging financial conditions related to credit availability within the banking sector. And I do think the Fed is potentially putting themselves in a bit of a corner here. as the year goes on, potentially becoming a political football as the election season draws on, but also really challenges the economy by passively restricting it with real Fed funds as elevated as they are.
And Tim, you mentioned politics there with this election. That's another big theme. And this weekend, South Carolina, Republican presidential primary. Tim, I'm just interested as an investor, how are you thinking about that, Tim? And how many times are you getting questions from your clients about that?
Yeah, we certainly are getting questions. I mean, obviously, the election and politics, tend to be one of the primary causes for investors to really, ultimately destroy capital, unfortunately, given some of their views. But at the end of the day, I think coming into the election, one of the sort of headwinds, I suppose, for the healthcare sector, as I mentioned earlier, is just the pending, potential change in regulation, depending upon how things shake out. But, overall, we typically don't see a lot of the policies enacted until the second year of the presidency. And so it gives us some time to understand, the magnitude and actual, reality of what some of these policies may look like, and ultimately how they can impact corporate earnings. And so, of course, the markets will always be forward-looking and posturing around that. But overall, options pricing has certainly indicated that actually, surprisingly, relatively low volatility is expected around the election outcome. And of course, a lot can change between now and then, especially with the geopolitical climate. But overall, it's not necessarily something that, we're taking into too much stock as we're valuing companies and trying to allocate capital for our clients.
Tim, thanks so much for helping us kick off the show today. Have a great weekend.
You too. Thank you.
Let's get to some trending tickers now. Shares of Block are soaring today. That's after the company raised its full-year profit guidance by more than $200 million, forecasting 2024 earnings of at least $2.63 billion. So heading into this one, Julie, this stock was not working, but it is now. It is surging. Results beat. Q1 guidance beat, and of course, a number of different units within this one, right, including Square, you've got Cash App, and revenue for Cash App jumped more than 30%, by the way, to $3.9 billion. That was also a beat.
Yeah, it seems like investors, analysts are also happy about the cost cutting that is going on. As we noted yesterday, Jack Dorsey in his letter to investors said, our workforce is now at 12,000, and 12,000 is the cap. We're going to operate below that. Harshita Rawat over at Bernstein has apparently compared Block to Meta in terms of its philosophy, its approach towards cost cutting and efficiency. And once again, she talked about the company finding religion on operating expenses. She said, quote, this helped to pull Block out of a no man's land of not being growthy enough for growth investors or profitable enough for those who are focused on growth at a reasonable price.
Yeah, well, if you're a bull, you like that comparison to Meta. That helps.
Yes.
One wrinkle there, I'm still interested in these reports, Julie, that whistleblowers alleging that Cash App didn't do enough due diligence, it sounds like, on customers, and apparently now regulators are probing this. So it's just one thing for investors to keep in mind and keep watching.
Yeah, definitely. Let's also talk about shares of Rivian. They are sliding today. UBS cut its recommendation to sell from buy, double downgrade, and slashed its price target on the stock from $24 to just $8. The concerns are over slowing demand. Yahoo Finance's Prasad Subramani has been tracking the EV sector closely. He joins us now. We have seen the challenges at Rivian, cut its production target for the full year, or it came out with a production target that was way below estimates. You get this double downgrade. It's a tough market out there right now for these guys.
Yeah, they have a few problems, a few issues here. First of all, with this UBS note, the big move was yesterday. They had to cut this,
Right.
they had a $24 price target.
Well, to be clear, they've been wrong, right?
Yes. Yeah. So they had to kind of catch up, and they did. But the main concerns are, like you said, production. Why is it so low compared to what Wall Street was expecting? Well, it's maybe a demand issue. Excuse me. Also, high prices are a concern. People aren't buying these $90,000 pickups. And with regards to Lucid, another company that also had an all-time low yesterday, same issue. Cars are too expensive, can't grow fast enough. And this is the big thing that I heard on both conference calls is analysts asking, when will you introduce the cheaper models that are supposed to come out? 2026 is when both companies are going to have these more higher volume vehicles. They couldn't say that they could push that forward, and that was a concern. And it's a concern that SPAC has brought up the UBS analysts, and a number of people are saying, why can't you pull forward these cheaper cars? They need to come out now because this is going to be a problem through 2026. The runways they have is probably through 2025. New capital raise will have to happen in the meantime. So that's the big concern.
Yeah, Rivian's got a new truck coming out on March 7th, but it's not a cheaper model.
Yeah. If you're bullish then, Praz, what's the thesis there?
I think that the thesis is that with regards to Rivian, the R2 is going to be debuted on the 7th. Supposedly a lot of interest there for this $45,000, $50,000 SUV, kind of smaller.
So it is a cheaper than their highest end.
Yeah. And look, the R1 Rivian and the Lucid Air are highly regarded cars. These are really, really good cars. So they have good tech, good IP. The question is, can they last longer? They have big backers, and Amazon for Rivian, the Saudi PIF for Lucid. The question is, are they going to step in again to get more money or new capital raises? But the big bullish case here is, can they bridge the gap to those volume vehicles like Tesla did? Remember, Tesla didn't make money for years. Model Y kind of cemented them as to where they are now. So that's the goal. And hopefully investors can kind of wait it out and not lose their shirt.
Yeah, we'll see.
All right, thank you, Praz. Appreciate it. Moving on to another trending ticker in the auto sector, shares of Carvana surging after the used car platform posted its first ever annual profit and issued better than expected guidance. Yahoo Finance Inez Ferre joins us now with more. Inez.
Yeah, and it was really interesting because in the earnings call, Ernie Garcia III, the CEO and chairman of the company, really put some commentary into context about the last couple of years for Carvana, because you'll remember, I mean, this was a pandemic darling, you guys. This stock was at $360 per share back in 2021. So he basically said it was really hard for a group to go through a period like that for 2 years and not disintegrate under the pressure. We didn't disintegrate. Basically saying, look, we did it. They announced a profit, an annual profit. They've been in restructuring mode really for the last couple of years, and it has been hard on them. They announced a debt exchange in 2023. They announced layoffs back in 2022, a couple rounds of layoffs. And Carvana posted net income of $150 million for 2023. That's helped by a gain of debt reduction. They also, for the first quarter guidance, they said that retail units would be up slightly on a year-over-year basis, and also expect an adjusted EBITDA significantly above $100 million. But look, what you're seeing on the stock price today, up about as much as 40%, is a short squeeze. I mean, this is a heavily shorted stock. 32% of the float is short. So you can expect to see that when you see these big, these headlines, these positive headlines or positive development catalysts, whatever you want to call it, that you will see these big price moves.
Yeah, most definitely. That's a really high. It's a high short interest position, 32% of float. Wow. Yeah, all right, Ines, thank you so much. We're just getting started here on Yahoo Finance Live. Coming up, analysts have been upping their price targets on software company NICE thanks to its strong AI-driven fourth quarter. We're going to speak to the CEO on the other side. Plus, South Carolina voters heading to the polls this weekend for its Republican primary. We're joined by an expert from Citi later in the hour who's been looking into what Trump 2.0 could mean for the economy. And mortgage rates climbing for a third straight week towards 7%. We'll speak with Zillow's senior economist in the 4 p.m. hour. Stay tuned. More Yahoo Finance coming your way. Binance's $4.3 billion payment has been approved by a judge as part of the plea deal the company and its founder CZ reached last year, making it one of the largest criminal penalties in U.S. history against the world's biggest cryptocurrency exchange. Jared Blickery has been watching it and watching the effect on the crypto market. Hey, Jared.
Hey, Julie, we've seen, and I'm watching Binance token right now, we've expected this ruling to come for a while. I don't know that it's much of a surprise. Down 1.63% today. You might be surprised to see the run-up that it's had recently with the price of crypto here. Take a look over 3 months, and the token is up 61%. And it's interesting. Now, CZ himself is expected to be sentenced in April of this year, and he may do about 18 months, which is a lot lower than the 10 years he could have been given, but that still remains up in the air. Also, Binance is going to have a court-appointed monitor for up to 5 years. I don't believe we know who that is just yet, but Sullivan and Cromwell has been floated as one of the top names. But let's take a look at what crypto has been doing aside from that. We can see Bitcoin down 1% over the last 24 hours, and here is a 3-month chart. This is a very bullish-looking chart, managed to break to the upside here in February after consolidating all the way back to December of last year. And let's take a look at the 5-year chart so we can see the price memory that we still have above. And basically, we're looking at this in here. Most of the hard work has been done, but you can see there's still quite a bit of price memory up to 60,000. Could be a little bit of a headwind there. You're going to need some more catalyst, but I think we get to 60,000. It's a sure bet we get to 70, and then you have 100,000 and those much higher targets inside. I'm sure we'll hear from Kathy Wood and the likes. Now, I also want to check out spot Bitcoin flows and also assets. GBTC, that's the Grayscale Bitcoin Trust, that has by far the most, 23 billion. Then you have the iShares, the BlackRock offering with over 5 billion. Fidelity's in there too, ARK, then it drops off. And just taking a look at the dollar amount of flows, which is right here, we can see Grayscale Bitcoin ETF, which did the conversion from its ETN status. That is down $7.4 billion. And then we've seen 5.7 billion into IBIT, and Fidelity's offering received 4.1 billion, guys.
Thanks, Jared. Appreciate it. Well, the AI hype and enthusiasm is continuing. D.A. Davidson, Wedbush, Oppenheimer all upping their price targets on a software company called NICE. It's thanks to the company's strong AI-driven fourth quarter. NICE's robust full-year guidance also topped expectations for earnings and revenue, helping lift the stock to a 2-year high. And the company called artificial intelligence an overarching catalyst for growth in the year ahead. For more, we are joined by Barak Ilam, NICE CEO. Barak, it's good to see you again. Thank you so much for joining us.
Thank you very much for having me back, Julie and Josh. It's great to be here.
Great. And so for those who are not familiar with NICE, you guys are using AI in particular for sort of call center assistance, right? You all make call center software. So I'm curious, as you look at your offerings, how many of your customers are using generative AI in what they're buying from you at this point?
You know, last time I was on the show, it was early June, and we spoke about the potential of AI and how it will impact the whole world of customer care and CX. And we talked about the theory over here. And here we are 8 months later, and we actually see it in motion. We reported our earnings yesterday, and we actually see it driving our business. And it goes to, you know, the demand from customers. Many of them tried to use, you know, generic Gen AI, and it just doesn't work for that particular purpose. It's very different the way enterprises adopt AI versus the way individuals do that. So the need is for very specific, tailored made, if you would like, and highly tuned AI based on very specific data that we have. And we see that demand really, really happening as we speak. And I think it speaks to our earnings in Q4, but also the guidance we gave for this year.
And so, Barak, so just looking ahead, I'm curious, and you're kind of touching on a point I wanted to raise. What is the risk, Barak, though, that, you know, down the road, customers, they start going to OpenAI and create their own virtual agents and kind of sidestep NICE?
I don't think we see that. We see customers trying to go that path, and then they come to us, and we see spike in demand on how many of those enterprises come to us. If you think about how AI is being used as a customer care, we would like to provide an outstanding care. We don't want any issues of either privacy, hallucinations, wrong answer, biased answers, if you would like. And for that, you need 100% accuracy. It needs to be fully secured. It needs to be able to augment people as well as providing an automated service. So it's a bit more complicated than just taking something like a generic Gen AI and apply it to the enterprise.
Barak, something else I wanted to get an update on since we talked last year is that issue you just alluded to, which is assistance versus replacement. How many of your customers are using only software to interact with their customers versus a person being assisted by software?
I think most of them see the perfect balance between the two. I call it augmented intelligence together with artificial intelligence. Think about a customer care environment. Most of the very basic services we no longer get from assisted service. We get it online or through the mobile. The things that get to that individuals are very complicated, and the amount of knowledge these individuals need to have is just outstanding. And for that, we need to make them 10x better. And the best way to do it is, of course, with AI, augmenting the user. But at the same time, some of those things, as they progress, can move to a fully automated. So the perfect match, and we see it with our customer, the perfect balance, is doing both, provide that, and the ability to toggle between them when there is a misunderstanding or lack of understanding of the customer intent.
Barak, let's talk competition as well. Legacy on-premise incumbents like Cisco, you've got cloud-based vendors, Genesys, Five9, Zoom now as well. In that fight, Barak, what are your competitive advantages?
We've been preparing for that era for the last decade. We've built a platform called CX1 from the ground up. There are no shortcuts in creating a platform, and you can actually see it from our growth. We are at a much higher scale as a company and growing faster, both in absolute number and percentages, and taking a market share. I think it's thanks to the completeness of our offering, the way we have built our solution, and our very strong financial foundation as a company. Look at our balance sheet and the rest of the thing that we're doing for our customers and the brand that the company has. So yes, we have competition, but we are expanding our market share these days.
Barak, I think we would be remiss if we didn't ask you about what's happening with your workforce, your own workforce. You're, of course, based in Israel, and I don't know what percentage of your workforce is there, but I just wanted to get an update from you on that as well, how that's affecting. Do you have folks who have been called up to serve in the war, and how are you sort of coping with all of that?
I really appreciate the question. First of all, as someone that was, born and raised in Israel, our hearts goes to everything happening over there, and of course, our hearts goes to the situation with the 134 hostages over there. In terms of our business, we didn't see any impact. We have 8,400 employees around the globe, 900 of them in Israel, and a few dozen of them were called for army service. Of course, we supported them throughout their service, and we are happy to welcome them back to the workplace, but there's been no impact to our business.
Barak, thank you so much for joining the show today. Really appreciate it. Have a nice weekend.
Thank you very much.
And coming up, South Carolina voters heading to the polls this weekend for its Republican primary. We're joined by an expert from Citi on the other side who has been looking into what Trump 2.0 could mean for the economy. Stay tuned. More Yahoo Finance coming up. President Biden looking to take a victory lap over the market's recent rally. And joining us now is senior columnist Rick Newman. Rick.
Hey guys, yeah, President Biden did something unusual for him recently. He bragged about the stock market in a tweet from a few days back. And you have to wonder, is this something that Biden plans to do as his reelection campaign heats up here? His timing is obviously good. I mean, we had recently new record highs in the S&P 500 and in the Dow. And if you guys are looking at the same Wall Street research notes I am, you're starting to see people anticipating Dow 40,000 when the Dow is going to get to the 40,000 mark. Now, as we have discussed many times, these round numbers don't mean anything special, except they do capture public attention. So when we had Dow 30,000, we had people with the hats, the celebratory hats. It said Dow 30,000. It does draw attention to the fact that we do have this stock market rally. And if we get to Dow 40,000, we only need to get about another 1.8% in the Dow to get there. I think you will hear President Biden bragging about this and trying to take a little bit of credit. I mean, he is obviously trying to find every way he can to get people to forget about inflation, which is the main thing that's bumming people out, and pay attention to the other things that are going well in the economy. So I think the other day when he said, hey, look at what the stock market is doing, that's a sign of confidence in the U.S. economy, I think that's a preview. I think we could hear more of that from him as long as this terrific stock market rally we've had for 3 or 4 months remains intact.
Of course, the question is who does that help him with? In other words, I would think, just off the top of my head, that the stock market continuing to rise would do more for wealthier American sentiment, right? Whereas maybe you could argue the ones who are being the most hurt by inflation are lower income Americans, and that's who he needs to convince, perhaps.
Yeah, of course. But, I looked up the latest numbers on how many Americans, what percentage of Americans say they have some ownership of stocks. And it's now at 61%. And if you think about it, that makes sense because pensions have been on their way out for a long time. And what most people have for a retirement plan, if you're lucky enough to have a retirement plan, is a 401k plan, which means you probably have investments in stocks. So this is not like it only benefits the wealthy. And, people who do have stock ownership, I mean, they pretty much know how their investments are doing. And, what economists call the wealth effect, it is a real thing. When your home value is going up or your investment portfolio is going up, you feel better off and you might feel more inclined to spend money. So do people need President Biden to remind them that their investments are doing well? I don't know. There's an obvious contrast here to President Trump, Donald Trump, when he was president. He bragged about the stock market when it was going up. He bragged about it like once every 35 hours, according to one study. I mean, he talked about it constantly. And of course, he said when it was going up, it was all because of his great policies. Stocks did tank at the beginning of the COVID pandemic in 2020, and then Trump didn't have too much to say about the stock market. But if stocks continue on the trend line they're on, just steady state, within a couple of months, Biden will be able to say the stock market under him is doing better than it was under Donald Trump at the same point. And if we get there, I think Biden's going to go for it for sure.
We'll see. We'll see if we continue to hear these kinds of tweets and brags from him. Thanks, Rick. Appreciate it.
Get your Dow 40,000 hats, guys.
No, I'm ready. South Carolina voters are heading to the polls tomorrow for the state's Republican primary. Former President Donald Trump holds a wide lead against Nikki Haley. He's expected to win the vote, with his next challenge being a rematch against President Joe Biden. If he once again wins the top job, what would that look like for the economy? City strategists have been looking into a Trump 2.0 economy. And Dirk Willer, one of the authors of the report, is joining us now. Hey, Dirk, thanks so much for being here. Man, I was reading through your report, and there are still so many questions and unknowns. That was the thing that really struck me here, is there are so many different scenarios that could play out between now and the election, and then after the election, right? Depending on whether we get a Republican sweep, whether we get a divided House and Senate, who ends up being... So how should investors even be beginning to think about this right now?
Yeah, thank you so much for having me on. It's indeed a fascinating topic that will keep us busy for some time this year. But I think the general way to think about it is that markets start to really care about the elections maybe 3 to 4 months in advance. So right now, we're still more in the process of figuring out the Fed. We're talking about the elections, but we're not really trading the elections. Now, that will change as the elections come closer. And what often happens is the market builds a big risk premium into the equity market, for example, during that period. But then after the election has happened, or even slightly before, a lot of that risk premium disappears again. So the rule of thumb, if you like, to trade an election is actually to get a bit cautious 2 months before, let's say. But then for the full year, you often get still very strong equity markets because the risk premium gets unwound pretty quickly after the election. In terms of topics, what does the market actually care about? You are right. We don't know that much yet. There are many outcomes. What I would say is it's very important whether it's a sweep from either side, actually, or not. Because if we do get a red sweep, for example, then the market might get quite nervous on very aggressive fiscal policy again. If it's a case of divided government, treasuries tend to do a lot better than when it's a unified government. And that's true for both sides, Republicans or Democrats.
And Dirk, switching gears a bit, I'm interested to get the city view on another issue, which is that, we talk, Dirk, as if, that it's Biden and Trump, that it's a done deal. But, I think special counsel Robert Hur raised new questions about Biden. I think with Trump, most Americans have probably lost count of the number of trials. What's the city view there? I mean, in terms of your team, do you believe it's a done deal? It's Trump and Biden. Those are the candidates?
I mean, nothing is ever a done deal, but our base case is indeed Biden versus Trump. I would say, there is sort of a tale where one of the candidates will not be in the final election. And then it depends a lot, actually, when precisely that would happen, when one of the candidates would actually be pulling back. And then it can either be a case where the electoral voters have to decide, or where the vice president will have to step in. So there's a lot of uncertainty also on the timing if something were still to go wrong. But our base case is, yes, it will be a rematch of Biden versus Trump.
And what's interesting to me as well, because your team looked at key policy implications of one presidency versus the other, specifically with regard to the economy. What struck me is there were some significant similarities between the two candidates on things like healthcare and on energy policy. It seems like on foreign policy, particularly with regard to China, even though posture-wise, maybe not much would change, there is, of course, the threat of additional tariffs coming from a President Trump. What effect would that have?
Yeah, no, you're right. I think the issues that people worry about with Trump on the negative side when it comes to markets and economic policies, indeed most of the tariffs, and a little bit the geopolitics, which could also, of course, play very much into market reactions. On the tariff side, as you know, President Trump has put out a 10% tariff against almost everyone and a 60% tariff against China. And he even mentioned, maybe 60% might not be enough. So clearly a very, very aggressive policy. And while the Democrats are not exactly China friendly for sure, I don't think you would see these type of headlines out of a Democratic government. So yes, the tariffs, if you remember, 2017 was a very strong year for the market because we were really riding on the tails of the aggressive tax cuts and the deregulation that the Trump term brought with it. And then the next year was one where really the tariff wars started to take center stage and the S&P was much more choppy. So the question this time around for the market is how important will be sort of tax relief and deregulation on the one hand versus, again, tariff conflicts on the other hand. And we do think in the end the S&P will be fine, but it will not be probably a year like 2017, which had just a very strong market because the tariff wars took some time to manifest itself. This time around, we expect to see that a little bit faster. And so still decent equity markets under Trump, but not as strong as during the last term.
And Dirk, whoever is going to win this contest, this election, Dirk, in 2025, they're going to face some big, serious fiscal issues and challenges. Walk us through those, Dirk. What's going to be on their radar, regardless of who's in the White House?
Yeah, as you know, the cuts, the tax cuts from the first term will run out by the end of next year, and then there is a question, to what extent they would be rolled forward. I think if it's not a divided government, very likely there will be some fiscal stimulus again, which the treasury market might not enjoy, and you could see a steepening curve, not necessarily higher yields because you probably have a Fed cutting at that stage, and so you get a steeper curve rather than high yields per se. But certainly, I think big fiscal stimulus either with a red sweep or with a blue sweep. But in any case, presumably some of these tax cuts will be rolled forward. But for the fiscal discussion, I really think it's almost more important whether it's a unified government versus a divided government rather than whether it's a Democratic or Republican victory. In either case, if there is a unified government, you will see aggressive fiscal policy, and that will not be a good thing for the back end of the US curve.
Dirk, it gets complicated very quickly. Thank you for helping us think through it. Appreciate it.
Thank you very much.
Shares of DraftKings higher today after getting an upgrade to overweight from Barclays. We're going to talk to the analyst behind that call on the other side. Shares of DraftKings higher today after getting an upgrade to overweight from Barclays. Let's now bring in the analyst behind that call, Brant Montour, Barclays Senior Equity Research Analyst for Gaming, Lodging, and Leisure. Brant, it is good to have you on the show. So you're a DraftKings believer, Brant. You go to overweight. Your target here goes to 50. How come, Brant? Just walk us through the argument of why this one is now a buy.
Well, thanks, Josh, for having me on the program. I and my team have come to really appreciate the strength of the underlying online sports betting market, the underlying iCasino market, and essentially the outlook for these two combined businesses and the ultimate size for these businesses. So we took up our expectation for the size of these businesses. We've been especially impressed by DraftKings' ability to gain and sort of sustain top two market share across both of those businesses, and we also think that there's sort of an emerging trend of parlay play, and parlay business is good for margins, is good for hold. We call hold in the casino businesses, which is how much the sports books keep of the betting volumes, and so that has a tailwind as well. So there's multiple things keeping DraftKings growing here, and we thought it was a good time to enter the fray on a 10% pullback for the last couple of weeks.
And Brant, just to dig a little bit deeper into that, and even bigger than DraftKings, you guys are increasing your estimate for the total addressable market of iGaming, of online sports betting. What changed in your view? What was revealed to you as this has been growing that makes you think it could be even bigger than what you thought before?
Yeah, thanks, Julie. So we took a harder look at the older states. So this is states like New Jersey, Pennsylvania, on the sports side, and Michigan, and we've been pretty astounded by how fast the revenue continues to grow for those older states. So 25-30% GGR gross gaming revenue continues to grow in those states. Now, we basically took up our total addressable market expectations for the sports side just on those older states alone, continuing to grow at reasonable rates from here, having outgrown what we formerly had expected those markets to get to. We haven't changed our expectations for internet casino, which you mentioned, which is growing at a healthy clip. Those older states for iGaming are growing 20% plus still as well, but we didn't change our TAM on that. And we basically need to see some movement on new states legalizing before we would up the iGaming side.
Gotcha.
And Brent, what about this news? Their decision to buy this lottery app, Jackpot, for $750 million. Brent, in your opinion, a smart move, a smart decision?
It's an interesting acquisition, right? It's a business that they're not in. I mean, I think we think about that business as a very rich customer acquisition pool. These are customers that obviously play the lottery, right? And I think that there's going to be a very good overlap between people that play the lottery and people that are willing to sports bet or try internet casino on their phones. We talked about the parlays, which are basically sports bets that become kind of like a lottery ticket, right? Picking 5 or 6 or 7 different outcomes of a game, or 2 games or 3 games, that you have to hit all of them correctly to get a very large payout. It's kind of like a long odds option, or like a lottery ticket. So I think that there's going to be a lot of overlap there. I think it's going to be good for their customer acquisition costs when trying to source customers from that. That's the point of the acquisition, not because I think that they want to be in the iLottery business longer term. I think it's more of a customer acquisition tool. I think it's going to be a good one.
And Brent, let me get you out of here on this basic question about valuation, because this one, it's had such a move, Brent. It's up about 115% over the past 12 months, but valuation must still look attractive to you, I guess.
Yeah, look, there's nothing like this in sort of brick and mortar casino land or hotel land or cruise land, the other sectors we covered here. I mean, it's more of a technology company. think it should be benchmarked versus internet companies and technology companies. When we look at internet companies below 50 billion market cap, growing top line like DraftKings is 20-25% on average over the next couple of years, those internet stocks trade at 4 to 4.5 times or above revenue. They trade at 25 to 30 times EBITDA, and this is within that range or even slightly attractive. So I don't think that that valuation is stretched. Valuation isn't a key reason why we have a buy on it now. It doesn't necessarily scream attractive on a valuation perspective, but it's also not stretched for what you're getting.
Brant, thanks so much. Have a great weekend.
Okay, you too.
General Motors is getting ready to resume testing of its robo-taxi unit Cruise in select cities. That's according to Bloomberg. Yahoo Finance's Prasad Ramani and joined us now with more. This was a tricky endeavor for them when it was going on. That's why they paused it. So sort of contextualize why it would be a big deal for them to resume.
Well, they had to resume at some point, right? There's too much money on the line. They had to somehow get back in the game here. And according to Bloomberg, they're going to do it on a smaller scale. Cities like Dallas and Houston, something like 10 cars or so running, but no passengers, right? That's the wrinkle here. They're going to have them just kind of out in the wild. They're doing some stops and things like that. But Cruise, for its part, had a statement saying that they had not set any timeline for redeployment. They didn't deny the story, but they didn't say that this is actually happening, and that they need to gain the trust of authorities and the public before they kind of continue. And I think that's kind of a big deal, right? Getting the, because it's one thing if the cars are out there with no passengers, but they're still out there, right? I thought they might have gone with a human co-pilot just to begin with. I think that would be in my opinion, be the right way to sort of redeploy. But we'll see what these cities of Houston and Dallas say. But yeah, GM has to get this going because it's sort of a big albatross for them.
And any reason you think they might be targeting, because I was reading through it, they're kind of targeting Texas specifically, right? Is that maybe kind of looser regulatory backdrop? Is that part of it, perhaps?
I'm not sure about that, but it sort of makes sense in terms of maybe there's just less human sort of density than San Francisco or Los Angeles. I think Houston and Dallas probably, Houston, I mean, even in Houston, it's just kind of like sparse urban sprawl. So maybe that works for them there. So
Where are they in terms of the robotaxi endeavors that are out there, right, from other companies? Because nobody is fully deployed yet.
Yeah, nobody is, but they were pretty deep in, like I said, Dallas and LA, San Francisco, obviously San Francisco with that accident that happened there. In these geo-fenced areas, I think Austin too, places like that, where these are bigger populations, bigger cities, so I think they were the most deployed of any of these robotaxi kind of endeavors.
Interesting.
Yeah. All right, Bruce, thank you, appreciate it. Coming up, closing bell on Wall Street, we're checking in on the latest market moves and the top trending tickers. Stay tuned.
There is the closing bell on Wall Street. Let's do a quick check of the markets here to cap out what has been an eventful week, the week of Nvidia, you might say. The Dow and the S&P, any rise for them today is another record close. The Nasdaq 100 is the same, and so it looks like we got records once again. The Nasdaq not getting there, though. In fact, closing below 16,000, down about 0.25%. We had utilities that were doing the best in today's session, along with some other consumer staple stocks as well. Looks like people getting a little rotating, perhaps a little defensive here. But as I mentioned earlier, it looks like you got to go all the way back before November. We've only had 2 negative weeks for the S&P 500 since that point in time, Josh.
And the major index is notching another weekly gain, and the S&P 500 just hanging on for a record finish. Jared Blickley is here with a look back at the action today and for the week. Jared.
That's right, Josh. For all the talk about tech and Nvidia, it was not the best week for tech overall and the tech-heavy Nasdaq 100. The Nasdaq Composite missing out on a record close once again. Haven't had one since November of 21. That's in the red for today and also for the week. Let's take a look at the 5-day totals here, and you can see, actually in the green for 57 basis points. So I stand corrected, but check out the Russell 2000. This was sunk Tuesday and Wednesday. We had, easy to forget, we had a nasty sell-off earlier in the week. Russell is ending the week down 2.2%, and the Dow, which has been outperforming, that's up about 1%. So let's take a look at the sector action. Julie, you were talking about staples. We have indeed seen staples get some attention lately. Not necessarily today. Today it's utilities and materials, but let me show you the 5-day totals here. Guess who the two winners are? Materials and staples. Boring old staples with Walmart notching those blowout earnings earlier this week, and then healthcare and financials and industrials, all those outperforming. Financials, industrials, healthcare at record highs, if not today, then yesterday. And it's really been a story this week, I think, about the broadening of the rally. And if you take a look at the leaders, you see a few here you haven't seen elsewhere. Home builders, that's XHB, that's at a record high. K-Web, China bouncing back, most definitely not at record highs, but they're gaining ground that they have lost. Korean stocks, that's EWY up 2%, and then some others, IBB is biotech, that's another interesting one. But I want to take a look at the losers here because I said it wasn't the greatest week for tech. It's really unprofitable tech. ARC components down 6% for the ETF, and we took a look at disruption a little bit earlier. Those were faltering. Then we take a look at TAN, that's a solar ETF, that's down 11%, very volatile. And IPOs in general have not been doing well, at least in terms of that ETF. And let's take a look at software, because software for the week, for the most part, was in the red. You'll see more than 75% of these names closing down substantially. Adobe down there, down 6% on the left bottom, all the way to Teladoc, down 32% on the right. And a little bit of a different story for the semiconductors, much more bullish looking than the software sector. Julie.
Thank you, Jared, very much. Well, shares of PDD Holdings turning negative heading into the close. That's after the information reported that U.S. lawmakers are calling for an import ban on all goods sold by Temu. Officials say the Chinese company has not done enough to, quote, prevent its suppliers from using forced labor. That's according to the report. PDD Holdings is the parent of China online retailer Pinduoduo and its overseas-focused retailer arm Temu. Is it Temu? I thought in the commercial in the Super Bowl they said Temu.
See, that's you're right. I heard Temu. That's right, which means I've been saying it wrong for a while.
I was saying Temu, then I saw the commercial, and I don't know, I've never shopped on the thing. Anyway, PDD has enjoyed a rapid rise in recent months, outpacing rival Chinese e-commerce site Alibaba as it focuses on aggressive international expansion. So the latest example here, after, say, a TikTok, that's the other one that springs to my mind, and ByteDance, of U.S. officials potentially having a material impact on a Chinese-based company.
Yeah, I mean, we've talked before about how maybe one of the few, if only, issues on Capitol Hill that Republicans and Democrats seem to agree on is often China. And one issue is kind of the national security risk they think it poses, and the other is the serious and ongoing issue of how the Chinese Communist Party treats its Muslim minority population. And I think this is another example of what you see there. And you know, for companies doing business there, Julie, how much line of sight do you ever really have? How much total and complete line of sight do you have into your supply chain in China? Whether it's PDD or another one, because you really, again, it's a country run by the Chinese Communist Party. It's not a liberal democracy like we have here. Your line of sight there is, I think, always going to be a bit cloudy.
Right, even for retailers and manufacturers that are based in the U.S. that get goods from China. Yeah.
We move on. Markets closing this week on a mixed note, but overall a strong week thanks to NVIDIA's results. Joining us now is Bill Smead, Smead Capital Management Chief Investment Officer. Bill, it's always great to have you on the program. It's an interesting moment here, Bill. You look at this market, we have run up far and fast, and you can forgive some investors, Bill, who might be listening right now, maybe feeling a little bit nervous, maybe feeling like they want to book profits here. On the other hand, AI, growing economy, expectation of cuts on the way. How do you see it, Bill? The market now, and what do you see ahead?
Well, our best guess, and when it comes to market predictions, we're guessing like other people guess, is this is the most like 1971 and 1972 in that there was an incredibly strong, what they called the go-go 60s market, with star managers like Jerry Tsai at the Manhattan Fund making 130% gain, and then a crushing bear market in 69, 70 for those kinds of aggressive, just in your preface here to us coming on, you showed a lot of weakness underneath the surface of the Magnificent Seven, and then a bull run at the end of that 69, 70 bear market that took us to all-time highs on the back of a narrow group called the Nifty 50, but really was two sets of companies. 24 companies were on both lists. That would be Disney and Coca-Cola and IBM and Kodak and a series like that. So what it means is we are late in a run-up that is likely to carry further and pretty much suck every dollar into this thing they can before they literally smash this game. And this is a game that we think will get smashed. We took a look at the price movement in 1927 through 29 on RCA. Now, let me preface this by telling you that in 1923, American homes, 1% of them had a radio. And in 1937, 75% of the people in their home had a radio, right? So a massive growth in a major important technology. RCA was the largest maker of radios, one of the two largest broadcasters of national radio shows, and one of the two largest content providers of radio. And the stock went parabolic, just like Nvidia, went from $10 to 110 between 1927 and the crash of 1929.
So Bill, I have great respect for historical context here, but do you really think that AI, which, if you listen to Jensen Huang, is going to permeate, not just everybody's home, but corporate America, right? Enterprise spending. Do you really think that's comparable to, people getting radios in their homes, and we'll see a crash like we saw with RCA?
29, it wasn't just radios. We sold 4,000 cars in 1900, and we sold 3.5 million in 1925. So it was radio, cars, and airplanes that were the new technology.
Okay, so what's going to happen now, though, that would trigger a crash like that?
Well, if you were allowed to know that, you would be the richest person on the planet. So the question is it different this time? And we always answer that, yes, it is different this time, but that's not the right question to ask. Does it rhyme? Does this rhyme with 29? Does it rhyme with 1972? Does it rhyme with the dot-com bubble? I have a piece coming out next week, and people are saying, Bill, the price of these things is not egregious like a lot of the dot-com winners were in 98 and 99. And I say, well, if you've got a fraternity brother that's had 14 beers, should he feel okay because one of his other brothers drank 24 beers? and hasn't passed out yet. And that's the problem. The problem is not whether AI is important. The problem is this is the late stages of a financial euphoria episode that Charlie Munger called the biggest in his career because of the totality of it. And this has just added a new leg to the totality. Can't you all visualize Matthew McConaughey walking down the road in his cowboy boots going, if AI is the new West, then data must be the new gold. Ka-ching, ka-ching, ka-ching. Just like the QQQ commercials in late 21 were heading us to destroy the Pelotons and Beyond Meats of the world.
Bill, you are in rare form this Friday, Bill. I don't know. Okay, so but we're gonna take a break and come back and talk to you in a little bit. But before we do that, just to take a brief pause from this. So where are you positioning right now, given that view of the sort of zeitgeist right now? Where are you looking for value?
We're in the intermission between the first leg and the second leg of a super cycle bull market in commodities. And we are buying oil and gas and own oil and gas. And then we like land, other than high-rise office buildings in expensive cities, well, we like land in the suburbs. And we have ways to get at that through home builders and mall REITs and other assorted fun things.
All right. Bill, good ideas here. And again, we're going to ask you to stick around. We're going to talk more later in the hour, so don't go anywhere. Thank you.
Mm-hmm.
Coming up, mortgage rates climbing for a third straight week towards 7%. We're going to speak with Zillow's senior economist about the latest housing hurdles. Housing hurdles on the other side. Existing home sales ticked up in January, boosted by lower rates in November and December, but mortgage rates have since reversed course, climbing up for a third straight week. Those elevated rates and low supply could mean a drought for the spring home buying season. With more on the impact, we're joined by Orphe Divounguy, Zillow senior economist. Orphe, thank you so much for being here. What is going to give in this housing market? This is the question we keep asking, and it seems like we remain sort of at a stalemate.
Thanks for having me. Look, existing home sales increased 3.1% in January. And sales is still down, right, relative to last year. This is kind of because the homes that sold in January reflected homes that went pending a month or two ago. But when you look at Zillow data, what you see is the dawn of the home shopping season. Sellers are slowly but surely returning to the housing market. Remember, fewer existing homes coming on the market in 2023 meant the housing market was supply constrained. But despite higher mortgage rates, we're starting to see some improvements on that front. New listings are up 6% when compared to last year, and inventory is also up 3% when compared to last January. So we're starting to see sellers return.
Is that more pronounced, Orphe, in some regions than others?
Absolutely. We're seeing the biggest uptake in some of these expensive metros like San Diego, Miami, Riverside, right? Listings are up 27% in San Diego, 22% in Miami. So you're starting to see that activity. In fact, when you look at price tiers, new listings for mid to high price tier homes have made the biggest rebound in January. So we're seeing that there's a ton of demand out there. There's still a lot of buyers out there. We got some great news in terms of population growth. We got great news in terms of productivity growth in 2023. And so you take that and you add the fact that the rest of the world is slowing down a little bit faster, and the US looks a relatively more attractive place to invest. So we're going to have buyers despite higher rates, and we expect a more competitive home shopping season when compared to last year.
And Orphe, when you talk about these buyers, do we have any kind of line of sight into who these buyers are? What's the demo with, I'm just interested given where the 30-year fixed is at.
Yeah, well, look, we have a lot of cash buyers, right? Cash buyers have kind of taken over. But we also have, if you look at what we're seeing in the market in January, what we're seeing is sellers, in an environment where there weren't a lot of sales in December, sellers coming back are not quite sure how to price their homes. And so you're seeing 1 in 5 active listings with price cuts. And so it means that if you're a buyer right now, if you're a buyer coming in early, you may be able to take advantage of the fact that sellers are not quite sure how to price their homes to get yourself a great discount.
Orphe, we recently spoke to Meredith Whitney, who was known during the financial crisis for being one of the folks who spotted the subprime crisis sort of coming. Now she says we are, over the next couple of years, really going to see housing prices come down. She says it's because older Americans, boomers, are really, those on fixed incomes perhaps, are really feeling the pain of inflation, consumer goods, groceries, et cetera, and they're going to be forced to sell at a higher rate perhaps than people are expecting. Are you factoring that into your models? Is that something you think is indeed going to happen?
Look, we've been waiting for that silver tsunami for quite some time, and it just hasn't materialized. Older Americans are less likely to move than younger Americans. The bulk of the wealth in this country sits with boomers, right? And so I'm not sure that that's actually a story that I see in the data right now, or that I think is likely to materialize anytime soon. I think we're probably going to see a huge transfer of wealth from boomers to their children in the coming years.
Orphe, I'm interested to get your take as an economist, where you see the 30-year fixed head from here. According to Mortgage News Daily, Orphe, 7.08%. Where do you see Orphe in 6 months, 12 months?
Absolutely. So look, it's very hard to predict where mortgages are headed, but we have a strong economy. We have a resilient labor market. We have those tailwinds I mentioned, right? Unexpected population growth, according to the Congressional Budget Office, robust productivity growth, higher labor productivity growth in the last year than we had if you look at the 10-year average before the pandemic. And so we're seeing a strong U.S. economy still. And with inflation coming down, it's actually supportive of strength for the consumer. And so I doubt we're going to see mortgage rates decline a lot anytime soon. if you think about it, what I've been telling people is, the last time that we had big drops in mortgage rates, where were they, right? The start, the dot-com bubble burst, the start of the global financial crisis, and the start of a global pandemic. So I don't expect a big drop in mortgage rates. I really expect the U.S. economy to keep humming. Mortgages might ease somewhat. We know that the Fed is done raising interest rates and that rate cuts could be coming. So mortgages might ease somewhat, but we're likely not going to see a big drop in mortgage rates anytime soon. But the consumer is in a good place. The labor market's solid. There are so many factors supportive of housing demand. And so that's why, we expect to see a home shopping season this spring that's going to be modestly better than last year.
And how do you, you're going right where I wanted to head, Orphe, is looking ahead now, that all-important spring selling season. When you say modestly better, can you quantify that for us?
Look, attractive listings are still moving very quickly. Despite the higher rates, homes that sell go pending in just 29 days, 1 day faster than last year and 18 days faster than before the pandemic. So, I think that buyers should, if you're in the market and you can afford it, you should act now because, things are probably going to continue to heat up and we're probably going to have a more competitive home shopping season. And remember, inventory is still 37% below where it was last year. And so there's not going to be a lot of supply. You look at new home sales, right? A sign that perhaps buyers are still out there. New home sales are up 12% when compared to last January. So, the constraint is still coming from existing homes not coming back fast enough. We have buyers out there, and those who come on the market will likely sell their homes very fast.
Orphe, it was great to get your views today. Thanks so much for joining us.
It was a pleasure. Thanks for having me.
As rates continue to handcuff new home buyers, Yahoo Finance is taking a deeper dive into the latest housing hurdles.
The U.S. housing market is facing a trifecta of challenges when it comes to affordability: tight inventory, climbing prices, and elevated mortgage rates. So what does this mean for buyers and sellers? Here are 3 things you need to know about the 2024 housing market. Number 1, inventory. People are staying in their homes longer. Thank you, baby boomers. The lack of homes for sale and high housing costs are just some of the reasons people aren't moving. Sales of previously owned homes hit its worst level in decades last year as elevated rates and rising home prices deadlocked affordability. The demand-supply imbalance will carry into this year. There is a 3.2-month supply of unsold inventory at the current sales pace. For perspective, at least 6 months of inventory is considered a healthy market. Despite the tight inventory in the resale market, the newly built home market remains attractive. New homes accounted for nearly 32% of single-family homes for sale, Redfin reported, marking the highest level of any fourth quarter on record. But inventory is only part of the story. There's also the dilemma with home prices. Number 2, home prices. Buyers beware, but sellers rejoice because home prices have never been higher. The median price for a home is around $361,000, up 5% from the prior year, Redfin reported. The pressure of limited housing supply has kept home prices elevated. Homes were 6.7% less affordable in December on a year-over-year basis, the National Association of Realtors reported. Despite elevated prices, builders were able to take advantage of lean inventories in the resale market and offer buyers incentives, including price cuts. The median sales price of a new home fell 6% from a year ago to $434,000. But it looks like home prices won't be leveling off anytime soon. Data from Wells Fargo projects new home prices to rise 2.2%, while existing homes are estimated to increase 3.1% this year. Number 3, mortgage rates. Another reason for the limited supply of homes has been the lock-in effect. At least 80% of homeowners who hold a mortgage had a rate of 5% or lower nationally in the third quarter of 2023, discouraging homeowners from selling and buying another in today's high interest rate environment. Rates have roughly doubled since the pandemic, thanks in part to the Federal Reserve's fight against inflation. Inflation remains stubborn, leaving rates elevated. Last year, mortgage rates rose above 8% in October, but have now come back down to range around 6%. Data from Freddie Mac shows that the average mortgage rate for a 30-year fixed loan climbed to 6.7% from 6.64% a week prior. Not much reprieve there. By contrast, home builders have been able to win the housing recovery by giving buyers what they want: mortgage rate buydowns. That's when the builder upfronts the cost to lower the rate on the loan, making new construction the place for deals in this housing market. Economists expect the housing recovery to stall over the next few months, given that long-term interest rates have jumped back up again this year. However, the hiatus will likely be short-lived. How will this economic picture play out throughout the rest of 2024? Make sure to stay up to date on the latest developments as Yahoo Finance continues breaking down everything you need to know about the housing market this year.
Berkshire Hathaway is set to report earnings on Saturday, and Warren Buffett will issue his annual letter alongside the results. For a look at what to expect, back with us is Bill Smead, Smead Capital Management CIO. Bill, one of the things that strikes me is, we were just talking about the enthusiasm for things like the Magnificent Seven and AI. Berkshire Hathaway touched a record high today, so it has also been a favorite among investors during this period of time. What is your biggest expectation, or what do you want to hear from Warren Buffett right now?
Well, we'd love to hear him expound on what Charlie Munger said a couple of years ago, that this was the biggest financial euphoria episode of Charlie's career. because of what he called the totality of it. And this Magnificent Seven being tacked on to FANG, being tacked on to the Beyond Meat market and Peloton market and meme trades and IPOs and SPACs and crypto and God knows whatever else they've thrown in there. That is the totality of it. So here's an interesting thought for you. Berkshire Hathaway is a very large cap stock. If you're a chicken and you want to own the Magnificent Seven, what's a chicken's way to own the Magnificent Seven? To buy the index, to buy the S&P 500 index. So massive amounts of passive money is going into the S&P 500 index, which is now just a glamorized growth fund because of having 45% in tech. So Berkshire Hathaway is probably getting net investment from passive money. And of course, Munger said he didn't like the passive money because he said, Larry Fink might be a nice guy, but he didn't want Fink to be his emperor, meaning voting all the shares.
Bill, a different question for you. The fact that Warren Buffett, greatest value investor of all time, is willing, Bill, to sit here right now on this just mountain of cash, $150 billion and counting. Are there lessons there, Bill, for the rest of us, for investors about the markets, about valuations here?
Yeah, it's a really good question. And I wish people would ask me questions like this more often. What we do as a company and what Buffett does with much larger amounts of money is patiently wait for things to come to him. It reminds me in sports, use basketball as an example. If you're a point guard, you're bringing the ball down the floor and you've got in your mind you want to call a play. That might not be the right play to call because the defense is set up way better to do something else. But let the game come to you. That's one of the brilliant things about Buffett. Let the game come to you. Wait until the opportunities come to you. So that's why it's great to have loads of cash. And he and Munger would both tell you that this isn't an optimal time to buy stocks the way when he wrote in late September of 2008, Buy American I Am, not because it was the bottom, but if you bought stocks over the next year or two after that, you were likely to do really well. And so we're more worried about his Apple position than we are about his cash position, because in many ways, he's called Apple the most wonderful company that he's owned. And the last time he did that was with Coca-Cola and General Electric. He called in the 98 annual letter, which would be 26 years ago, he called Coke and Gillette the inevitables. And they were very poor performing stocks for the next 10 to 12 years. As John Neff, the great manager of Vanguard Windsor, once said, when you want to brag about a stock, you should probably sell it.
So you think he should sell Apple?
Well, he just did sell some Apple.
Well, sell some or sell all. Do you think he should exit the position?
Well, certainly after the mania that we're seeing, it is a very, very, very large company that it takes a lot to move their needle now. And I would not be surprised to see him be a relatively consistent trimmer in that stock. Not because it's not a great company, not because I wouldn't want to own it at 12 times earnings, but these large, mature growth companies have had a halo of investors just seeking exactly that. Large, consistent growth with a wide moat. That might be the most popular trade outside of the Magnificent Seven.
And Bill, one kind of mystery out there, and the Journal touched on this recently, which is Berkshire wrote for a second consecutive quarter that it was requesting confidential treatment from the SEC for one or more holdings it omitted, Bill, from its public 13F filing. What do you make of that, Bill? Why all the confidentiality here, you think?
Banks are the cheapest relative to the S&P going back to like 1941. So if he is buying into a bank or an insurance company, he's doing what he always does, which is taking advantage of a deeply out of favor sector in comparison to the rest of the stocks.
Bill, finally, you mentioned, of course, Charlie Munger, who was the consigliere for Buffett for so many years. This is going to be the first letter that we will get from Buffett since the passing of Charlie Munger. How do you think he's going to sort of process that in writing to investors?
Well, he'll certainly honor Charlie. I'm a 65-year-old guy that's 43 years in the investment business. And I can tell you that I feel very strongly about my best friends over the years in this industry. And in effect, Charlie has been his business spouse, so it's very hard. And I'm sure he'll honor him in his comments. And I'm sure he'll say a few things. Well, if Charlie was helping me write this, he'd probably say this. And we're big fans. Our podcast is called The Book with Legs in honor of the fact that Charlie's family called him a book of legs because he always had his face stuck in a book all the time. Very difficult. Again, what I'd hope to see, I don't know if you remember this, probably 12 years ago, but Buffett mentioned what a good job Lou Simpson was for picking stocks for Geico. And he said in tiny, tiny print, yeah, he's done a lot better than me the last couple of years. We'd like to see that kind of reference to Todd and Ted, because they are definitely now much more on the forefront. I would like to see them spend a couple answering questions with Warren, more so than Greg Abel, who does a great job of running the operating businesses. But we're all hungry for thoughts on how to pick stocks or why they like the stocks they like.
Yeah, that makes a lot of sense, Bill. Thank you so much for spending so much time with us today. Have a great weekend.
Yeah, thank you for having me.
Take care. Coming up, luxury stocks have been bouncing back as of late. We'll dive into whether the sector still has room to run on the other side. Luxury stocks are bouncing back, but only for a few names, despite warnings from Wall Street about a slow recovery in China and less demand in Europe. Companies like LVMH, Hermes, and Cartier have had strong seasons. Here to help break it down and discuss trends going forward is Pauline Brown, former chairman of LVMH North America and current CEO of the advisory firm Aesthetic Intelligence Labs. Thank you for being here. It's good to see you.
Thank you.
So it has been sort of surprising that we have seen some of sectors of luxury hold up pretty well here. What do you think is informing that, and why have we had some that have done quite well and others that haven't?
Well, it's definitely not a factor of the sector. It's really a factor of the brand. The powerhouse brands, Hermes, Brunello Cucinelli, Moncler, they continue to shine really bright. The laggards, Burberry, Ferragamo, Lanvin, they are struggling just to break even. They're struggling just to go flat. And so there's this increasing bifurcation between the high performers and the rest. And there's also an interesting divide among the consolidated players like LVMH, between the diversified ones like LVMH and the less diversified ones like Estee Lauder, which is all in beauty, or Richemont, which is mostly in watches and jewelry. The latter have not been doing nearly as well as the diversified players.
How much, Pauline, do you think, kind of the momentum we're seeing here with the luxury shopper, how much would you pin on that in the stock market?
Some, not a direct correlation. There are definitely segments of luxury spenders, high net worth, ultra high net worth, whose net worth is very tied up in stocks. And when they're feeling confident, when they have events and travel and all the things that go with the stock market, they spend. But most of the growth of the last decade or two has come from aspirational consumers. And I'd say the housing market, jobs, other factors have more played into whether they're in the mood to go shopping. And they are, by the way, they are shopping.
Yeah, it seems like. I mean, it's also interesting if you look at the trend that we have seen among middle-income shoppers to do stuff instead of buy stuff, right, over the past year. How is that playing out with the luxury shopper? Are they just doing both?
Well, some of it is when you do stuff and you are visible,
you also want to look good.
Yeah, have to look good. So there's always a bit of a compulsion to buy stuff to look good while you're doing stuff. So that certainly plays out for travel and for weddings and other big occasions, even for going out to dinner. The reality is there is some shift going on in terms of experiences versus goods. And what is a really interesting trend, which I'm going to continue to watch, are the bigger luxury brands going into hospitality. So for example, Vuitton will be opening its first ever hotel in Paris, Vuitton Hotel. RH, another business, home furnishings based here in the US, they opened a very successful restaurant, starting with the one here in the meatpacking district. Dior, Christian Dior, has a patisserie, a cafe, in their French flagship. So I think you're going to see that. I don't think those initiatives make money. I don't think they're very profitable, but I think they bring people into the store.
Another big topic, Paul, and we talk a lot about on this show is China. What are the trends there with regard to luxury shopping?
A few things. First of all, they're much more discriminating now than they were 5 or 10 years ago. So if I said before there's a bifurcation between high-performing luxury brands and the rest, I think the Chinese have shown a level of sophistication that is playing into that as well. Secondly, they're not spending while they travel to the same extent that they did. So they're spending a lot more at home. They are traveling. They're not traveling to the US or Europe in the same numbers, but they're going to Korea and to Japan. But they've become accustomed to shopping locally. So where they're buying has shifted. And here in the US, if you speak to any of the local luxury general managers, they saw a huge drop-off in Chinese shoppers visiting the US for that very reason.
To just drill down again into that bifurcation that you alluded to, is it a matter of execution? Is it a matter of creativity in terms of offering what people want between the ones that are doing well and the ones that are not doing as well? What's the distinction?
Well, yes and yes. It is both of those. What I would say is you take a gold standard like Hermes. Yes, they execute well. And yes, they have first-rate creativity and artistry and craftsmanship. But they also have, I think, managed this very delicate balance between heritage and modernity. So how do I stay true to what I have always stood for, and how do I continue to create new desirability and feel relevant to the times we live in? Many of the luxury brands, particularly the younger ones, I think have gone way too heavily into the trend, into the contemporary, into digital marketing. And I think in the process, they've lost their roots, they've lost authenticity. And they also have overexpanded in an effort to be so commercial. Whereas Hermes has been very, very disciplined in not overexpanding. If they wanted to double their business tomorrow, they could. But they know that if they want to be around in 100 years from now, they better restrain that growth level.
Oh, that's interesting. Sustainability from another perspective, I guess.
And yeah.
While we have you here, we're sort of in the midst of fashion season, right, with all the shows. And I just wanted to get your take on what role those shows, the catwalks, play in this era. I mean, like I was telling you in the break, I was seeing some shows on social media that were fun and caught my attention for the first time in a while.
So I am of the mind that in the years to come, that let's call it the bottom 80%, will pull back from that trend. The return on investment is not good for them.
It's expensive to put them on.
It's very expensive. A global brand, the brands that we've referenced earlier, can spend upwards of $15 million on a single 10-minute show. And nobody's buying those clothes, right? They're not featuring clothes that they necessarily would have in the stores. They're not making a lot of those pieces. It's all about image. It's a way to stay relevant, to get editorial coverage, but more and more, it really is just a social media play. Back in the day, and it wasn't that long ago, there were two people in the audience, two types of people. You had the editors and the merchandisers who were there to place orders. Now, when so many of those brands have their own stores, so they don't need to sell to Saks or others, and the editors, Anna Wintour and others, aren't really determining what's in, what's not, vis-a-vis social media influencers, that whole dynamic has gone away. And so I think if anyone were really looking at it as we look at other marketing metrics, they probably question whether they should continue doing it, given all the noise, given all the competition, and given that most of them are really making money in other parts of the business.
Interesting.
All right. Pauline, thanks so much for joining us today.
Good
That
to
was
see
really
you.
helpful. Appreciate it.
Good to see you.
Coming up, what to watch next week. We're going to break down the stories you need to know to start your Monday. Shares of Fox scoring an upgrade today thanks to optimism on the entertainment company's planned sports streaming bundle with Warner Brothers Discovery and Disney's ESPN. Joining us now is the analyst behind that call, Jason Basney, City Managing Director. Jason, always good to have you on the show. So you upgrade Fox to a buy, Jason. Your target goes to 35. How come, Jason? Walk us through the argument.
Well, there's a lot of skepticism about the efficacy of this sports bundle on two fronts. One is a lot of investors don't believe that consumers are going to buy it because it only contains about half of the sports rights. And the second reason is they fear that a lot of people will buy it, but they're going to spin down from their big fat pay TV package to something that's cheaper and thinner, and that's going to hurt Fox. That's why Fox traded down on the news. Our thesis is pretty simple. A lot of people are going to buy this, and it's actually going to bring in cord cutters, cord nevers that have never had a pay TV subscription. And it's actually going to be positive for the stock.
And is it going to benefit Fox more than the other members of the venture?
It will. I'll tell you the ratio. The ratio that we look at is if you look at a media company, how much of their affiliate fees are they getting from sports versus how much are they getting from non-sports? The more you get from sports, the simpler that ratio is for you to digest. So in the case of Fox, they could have 2.5 people spin down from a big fat bundle to this sports JV for every new person that signs up. If you look at someone like Warner, it's almost 1 for 1. So it definitely benefits firms like Fox and Disney much more than it does Warner, and certainly more than people that aren't in the JV.
And Jason, what's your best guess about what the price of this service would be? You know, some of the reports I've seen, I'm sure you've seen the same ones, maybe 40 to 50 per month. It sounds kind of pricey, but what do you think?
Well, I just added up all the affiliate fees that they're getting today that are for those linear channels that are going in the bundle, and then marked it up 35%. And I came up with a $36 price point. So I think you could see something in the $35 range early on. Maybe it goes to 40. I don't think it gets to 50. What's interesting is that if you took what we think this bundle will cost, and you bought Paramount and Peacock on top of it, that would get you in the $50 range, but then you'd have 85% of all sports. If you include Amazon in that, you'd have 90%. So you're essentially talking about every piece of sports content for really something that I think will cost $52 a month.
Jason, I want to move on to one of the other members of the joint venture, Warner Brothers Discovery. The stock trading at a record low after it reported disappointing numbers, or numbers that at least disappointed most of the street. I believe you still have a buy rating on the stock. What's going to get it to go up here?
We do still have a buy rating, and our thesis was pretty simple. It was just that the amount of free cash flow that they would generate, they would use it to pay down debt, and essentially your debt would become equity. But even if your enterprise value didn't change, what ended up happening today, and it's happened for a couple quarters in a row, is the EBITDA keeps missing street estimates. And what's essentially happening is the pressures on the linear ecosystem are just occurring faster than the improvements they're making on the streaming side. It's pretty much that simple.
And Jason, so you have a buy on it, but what are the kind of downside risks you would flag, Jason?
Well, more rapid cord cutting, weaker viewership on linear television. And then on the other side of the ledger, the thing that, most of the miss that they had in this quarter was really at the studio. That's a little bit of an aftershock of the strike, and that will persist, I think, probably at least in the first quarter, maybe even the second quarter of this year. And then things should get back to normal where the studio begins to perform better.
Jason, always love having you on the show. Thanks so much for taking the time to chat with us. Have a great weekend.
You bet. You bet. You too. Thanks, Josh.
Time now for what to watch next week. On Monday, the Dow Jones Industrial Average will have a new look. Amazon is replacing Walgreens Boots Alliance. Also, if you're a Walmart shareholder, you're going to notice the price of the stock has gone down thanks to a 3-for-1 stock split. But the value of your holdings will remain the same, as you'll now have 3 shares for every 1 you previously owned. It's a cosmetic move, but Walmart is making the change in an effort to make the stock more accessible to employees.
On the earnings front, we'll hear from Zoom and Workday after the closing bell on Monday. Investors will also be digesting the results from Warren Buffett's Berkshire Hathaway. They'll be out over the weekend. Other key names to watch include Lowe's, Salesforce, HP, and Paramount Global.
As for economic data, all eyes will be on the PCE report, the Fed's favorite inflation gauge. that report out on Thursday, and the expectation is that headline inflation growth will come in at 2.4%. Core inflation will be up 2.8% from a year ago. And on the heels of the numbers, we'll be hearing from a slew of Fed officials who are pushing back expectations for a rate cut until later this year. So PCE, Julie, that's what we're focused on. That is Jay Powell's preferred gauge. Of course, recent inflation gauges, maybe not so great relative to expectations, CPI, PPI. With PCE expectations, 2.4% year over year. That would be ticking down from 2.6% we saw last time.
Yeah, and one of the things that people are watching is that one of the components in, I believe it was PPI, that are asset management fees that have been going up. That's something that then feeds into PCE. It's one of the components and one of the things that's going to put some upward pressure on it. Of course, the Fed and economists like to strip out all kinds of things to try and figure out sort of what real inflation is, meaning how sustainable is it at this level. So we're going to see that exercise once again with this PCE report.
Yeah, it's interesting because we got of course, this week too, we got the minutes from the Fed's last meeting. Still very concerned about inflation clearly. And that was before the CPI and PPI prints.
I'm sure we're going to have that discussion once again when these numbers come out. Well, that'll do it for today's Yahoo Finance Live. Be sure to come back Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Have a great weekend, everybody.